6 p.m. We'll get started very shortly. I know people are still signing in, so we'll get a few more people on and then we'll get started. Sam, I'm hoping you can hear us. No, Tamara can't. Hi, Tamara. Can everyone hear us? Can you hear us now, Tamara? I once did a whole webinar and no one could hear, and we didn't know. That was years ago. That was at like the start of COVID when technology was just starting to really take over. Bobby can hear us. Okay, so I'm going to assume that we're live. Everyone can hear us. Sam can hear us. Everyone can see us. So I'm going to get started. I want to jump right in. I want to respect everyone's time. We are going to record this, so anyone who has to step off or is joining us later, we're going to send out a recording. I've got two really great guests, and I'm personally really excited to learn a lot about MLI Select myself because it's somewhat new, but definitely a unique product that allows investors to get in with minimal money and still generate strong cash flow. And a lot of people are like, Ryan, how does that actually happen? And that's why this is going to be a really informative, really educational webinar to stick around for. But this is really why MLI Select qualified properties are creating a ton of demand, which we'll talk about. So I really wanted to put this webinar together to educate people. And it's important for investors to understand how it works so that when the right opportunities actually come up, investors are ready to act. And that's why I'm hosting this. It's about education, but also helping potential investors prepare to move quickly when opportunities arrive. And to all of our past purchasers, both new and seasoned, we're always committed to continuing to bring you vetted opportunities, high quality opportunities. And, at Connect, we only bring the best opportunities. So that's why we've waited for the right MLI Select partner. We've been learning about it in the background. You've probably been reading about it, but I'm really excited to have a partner to collaborate with here through Baker Real Estate. I've been working with Baker Real Estate for, close to 20 years now. I've got Linda and Carol here from the Baker Real Estate team, and Baker has created an amazing program and works with select builders to deliver great results. And we represent our investor clients. So that's why it's really important to work with a team that has really vetted the builders, vetted the process, and we're going to learn all about that. So just to prepare everyone before we jump in, at the end of the webinar, anyone interested can register to get information on the deals that Linda and Carol are going to talk about. We'll send out a recording, so if you have to take off, no hard feelings. And an expert on our team will be available as your go-to agent once the details are out there if you have any further questions. And I think at the end of this, Linda and Carol, if you could stick around, we can ask a few questions and hopefully answer everyone's questions by the end of this. So without further ado, thank you for joining us. Let's jump right in.
Okay, sounds good. Thank you, Ryan. Just want to say hi to everyone. We're super excited to be here today with Connect Realty. As Ryan mentioned, we've had the pleasure of working with Ryan for many, many years. It's always been a great experience with the collaborations we have. Baker's been around for over 30 years. We do work with very select builders. We have the largest market share in the pre-construction space in North America. So we have been focusing a lot on the CMHC MLI product as part of the commercial division, really trying to tailor a program that works for the investor. And pretty much we've gone through all the pain points of the process and created a package that is, in our opinion, as risk-free as possible, and allowing you to take advantage of a really, really great program. It's a great time to explore right now real estate opportunities in today's market. Despite some uncertainty, there's really strong investment opportunities, especially with this program. Game-changing program that really opens up a lot of eyes for investors with a 50-year amortization, as low as 5% equity requirements. It just makes it easier for investors to get into the market in this space and actually make some money. So we're really excited. We've done extremely well. Want to unlock this opportunity to you in the Connect Realty Group. So let's get started. I'm going to hand it back to Carol, who's going to go over all the details about the project, and we'll talk about some opportunities that we have specifically later in the presentation.
Thank you, Linda. Thank you, Ryan, and the team for coordinating this seminar. And to those who are tuning in today to learn more about CMHC MLI Select, it's such an incredible initiative that you can leverage to maximize your returns and be able to build long-term wealth. And today we're going to go over the details of the program, how you can qualify, and if this is the right investment for you. And we'll also talk about one of the best performing markets where you can take advantage of this program, go through the pro forma numbers, and see how profitable these investments truly are. And then, of course, end it off with a Q&A. So let's dive right in. So one of the reasons why CMHC introduced the MLI Select program is to address a very critical issue that Canada has been facing for the past 10 years, and that's a shortage of affordable homes. It's characterized by a shortage of affordable homes and escalating home prices. In fact, home prices have outpaced household incomes, and depending on what city that you're in, we're seeing as much as 14 times that of household incomes, putting home ownership out of reach for many Canadians, particularly young Canadians. And despite consecutive interest rate cuts, we're still in a relatively high interest rate environment. And this, coupled with high home prices, have made mortgages less affordable, driving Canadians to seek rental housing as an alternative. And the trend is, as affordability declines, rental demand rises, creating strong opportunities for investors. And this is something that's important to highlight because as more rental demand comes to the surface, that means lower vacancy rates, stable rental income, and consistent property appreciation. And the graph on the left that we're showing there is the forecast of the affordability in Canada. And in the next 10 years, the projection is that it will trend downwards, which is great, but still above the affordable range. So there is still much work to be done to restore housing affordability. So how short is short? According to CMHC, Canada needs to build an additional 3.5 million homes beyond current projections to restore housing affordability by 2030. And this estimate considers factors such as population growth, income levels, and housing market trends. And at our current pace right now, we're not building fast enough to close this gap. So what is being done to address this crisis? So recognizing the urgency and the fact that this has been a decade-long crisis, the federal and provincial governments are putting together various initiatives in order to restore housing affordability. So we have like the National Housing Strategy, we have the Rapid Housing Initiative, and finally, we also have something called CMHC MLI Select program. Okay, and this is a program that has been gaining a lot of popularity in the real estate space. Like Linda had mentioned, it offers extended amortization and incredibly low down payments, and this is centered around multifamily properties. Okay. So before we get into the program details, some of you may be wondering, what is CMHC? And is CMHC MLI Select a reliable source of investment? And the answer to that question is yes. CMHC is a federal crown corporation that is backed by the Canadian government with a mission to provide Canadians with affordable and sustainable housing. They also conduct extensive market research, providing unparalleled insights and data. And they also provide insurance products to lenders, which significantly reduces the risk in the event of a mortgage default. And so this lower risk translates into more favorable financing terms for the borrower, such as lower than market interest rates and premiums. So now let's talk about the program itself. MLI Select, which stands for Mortgage Loan Insurance. It's a relatively new program. It was introduced in 2022, but again, has been gaining tremendous amount of popularity in the real estate industry. And MLI Select is a very innovative financing program that supports multifamily rental housing with an emphasis on making it more affordable, energy efficient, and accessible across major municipalities. And it's a tool designed for developers and investors because of its incredible financing terms that it offers. So you can get up to 95% loan to value. So you can buy multifamily with as little as 5% down. So less equity is required upfront, freeing up capital for other investments. You can also get up to 50-year amortization. So this lowers mortgage payments, improves cash flow for easier long-term wealth building. And it also offers lower interest rates and insurance premiums, providing you with better returns. And so these financing terms are very favorable because in comparison to traditional financing, you wouldn't be able to find this anywhere else. Okay, so there are a few requirements to be eligible for this program, which includes, number one, a commitment to social and environmental outcomes. So that's a commitment to making the multifamily more affordable, energy efficient, and accessible. Number two, minimum of 5 units on any given lot with no restriction on size or bed type. Number three, if there is a commercial component, it cannot exceed 30% of the gross floor area and the total lending value. And I just want to take a quick minute to highlight how this is such a great opportunity for investors who are looking to acquire mixed-use multifamily properties under this program. And why this works for investors, because it allows an investor to be able to own a stable cash flowing asset with both residential and commercial revenue. So using less capital upfront, we typically see around 7% down for mixed use property in Edmonton, Alberta. And you can benefit from up to 50 years of amortization, lower interest rates and premiums, again, which are not available through traditional lenders. So that's number three. And then lastly, the fourth requirement is the debt service coverage ratio, which is at 1.1. So this is a key metric that is used by lenders to assess how well the property is generating income to cover its debt obligations. So, for example, a DSCR of 1 means that the net operating income exactly covers the debt payments, which is considered your break-even point. So a DSCR of 1.1 means that the property will generate surplus income beyond its debt obligations. So in other words, the NOI is at least 10% more than the debt service. Okay, so we just talked about the project requirements, and now there's a personal component to it, which is the borrower requirements. So in order to qualify for this program, you would need a net worth that is equal to 25% of the loan value with a minimum of $100,000. We like to be slightly more conservative, and to increase your chances of being approved by the lender and CMHC, we advise our investors to have 25% of the purchase price. So for example, on a $3 million multifamily, the net worth requirement would be $750,000. And so with respect to this program, this is considered construction financing. So a lender would look at your net worth because they view these loans as more business investments. And they look at your net worth as a measure of financial stability and to ensure that as a borrower, you have enough financial strength to cover any unexpected costs, vacancies, or market downturns. It is also recommended to have 10% liquidity, which can come from your net worth. And lenders typically like to see this to ensure, again, that you do have enough financial strength and finances to cover any short-term obligations. Okay, so how does this program work? So the program is based off of a point system, depending on how many points you accumulate with a maximum of 100 points. And it will determine your eligibility for more competitive financing terms. And you get points by meeting specific benchmarks in 3 key areas. So again, affordability. So projects are based or scored based on the percentage of units that meet affordable rent threshold. Energy efficiency, so developers must meet or exceed energy efficiency targets. And lastly, accessibility, projects that integrate accessible housing features as part of the multifamily property. So here we're showing the scoring model for new construction. And it's important to note that this program actually applies to both existing properties and new construction. But for the focus of this particular seminar, we will look at the point distribution of new construction because our inventory will be all new builds. Okay, so when we take a look at this, the point distribution, you'll see three different components: affordability, energy efficiency, and accessibility. Under affordability, you can score 50, 70, or 100 points based on the percentage of units in the property that are rented at 30% of the median renter income. So for ease of reference, what we did here was we show a table at the bottom listing out a few cities with their median renter income and what the corresponding affordable rent threshold is. And this is public information that you can find from CMHC, and this is released on a yearly basis. So let's take a look at Edmonton, which is highlighted in red. We have a median renter income of $66,600 with an affordable rent of $1,665 per month. And what's quite interesting is that Edmonton's median renter income is higher than Toronto and almost on par with Vancouver. But as we know, the Toronto and Vancouver markets are more expensive, so the average market rents would actually exceed the affordable rent listed. On the other hand, in Edmonton, we're seeing that Edmonton's affordable rent is similar to market rents, and that's how we're able to get better returns than other markets in Canada. In terms of energy efficiency, you can score 20, 25, or 50 points based on the percentage that exceeds the National Energy Code and the National Building Code. And then in terms of accessibility, you can score 20 or 30 points based on the percentage of units that's in accordance with the CSA standard, if it meets universal design or has a Rick Hansen Foundation accessibility certification score. Now, there's another way to score more points, and if there is a commitment to this program for 20 years, you can actually score an additional 30 points. And like I had mentioned, the maximum is 100 points, but with 100 points, you actually get the most enhanced financing terms. So we're going to look at that a little bit more closely under the affordability scoring. So given that 100 points is the maximum, you can score all of your points under affordability, and it offers much more favorable and flexible terms with new construction. So here you can see that regardless of how many points you accumulate, you're still able to get up to 95% loan to value, and it's the amortization and the insurance premium that scales slightly. So at 100 points, you get 95% loan to value, 50 years amortization, and the lowest insurance premium at 2.8%. And then if in comparison to 50 and 70 points, you'll see that the amortization and the insurance premium is is different. Okay, so how can you leverage this program? So how can you leverage this program to make your hard money work for you? And here we're showing the traditional residential financing versus the CMHC MLI Select commercial financing. And the example we're going to give is, let's say you want to buy a residential property at $750,000. At $750,000 with an 80% loan to value means that you would put down 20%. 20% of $750,000 would be $150,000 with a 30-year amortization. Okay. Now, for the same amount of down payment, you can instead purchase a $3 million multifamily property with 50-year amortization and 95% loan to value, because MLI Select offers these competitive financing terms. And so under this program, you can actually gain or get more higher purchasing power, which is 4 times more real estate than the same capital investment. You get higher leverage, so a 95% loan to value, which allows investors to really maximize the returns by using less of their own capital. Lower interest rates compared to traditional financing because MLI Select is CMHC insured, and overall lower monthly payments and enhancing cash flows because of the extended amortization. So you can see here that by leveraging MLI Select, you as an investor can acquire significantly more real estate with less capital and benefit from lower financing costs and build greater long-term wealth compared to traditional residential financing. So hoping everyone's ears are perked up at this point and we have your undivided attention because this is such an incredible opportunity. Again, higher purchasing power, higher leverage, lower interest rates, and lower monthly payments.
And it sounds like potentially a lower barrier of entry, meaning, not your standard residential financing as well. If you've got the net worth, it's easier to qualify.
100%. And the borrow requirements are slightly different with commercial financing because they look at your net worth as opposed to residential financing, where the lender would look at your income and your credit.
And I know questions are coming at the end, but I'm curious about this part. So is there a threshold in terms of how much you can borrow? Can you do multiple properties like this?
That's a great question, Brian. So you can actually acquire more than one multifamily property and use the same net worth in order to qualify and purchase more than one.
Correct.
So that's, I guess, like one of the main differences, again, when you compare commercial financing with residential financing because of the way that it's structured.
Right.
Yeah. Okay. So, for those who are tuning into the seminar so far, chances are you might be from Toronto, from the GTA, maybe within Ontario, and may not be familiar with the Edmonton market. And I find that we typically avoid what we don't know because it might feel distant or foreign. But when you really look at the market fundamentals, you can really see that Edmonton is one of the best performing markets. So that's what we're going to get into next. Where this program is available nationwide, but as a team, as a commercial team, we've looked high and low, near and far to see like which markets will give you the best returns. And we've identified Edmonton, Alberta as that market. So there are several reasons why Edmonton is one of the best performing markets. It truly stands out as a prime investment opportunity in Canada, and it offers a combination of economic stability, strong population growth, affordability, and a thriving business environment. And as Alberta's capital city, it serves as a major economic hub with diverse industries driving long-term growth. So we're going to look at Edmonton at a glance. And what we're seeing is that the city is experiencing rapid population growth. And the latest estimates from Statistics Canada indicated that the province had the fastest demographic growth in Canada at 4% and recorded the highest net interprovincial migration that's ever recorded by any province. So there's strong population growth. Edmonton also has a very young demographic with a median age of 36, which is fueling demand for housing and rental units among young professionals and their families. Alberta is also a magnet for businesses, offering the lowest corporate tax rate in Canada at 8%. There's no provincial sales tax, only 5% goods and services tax, making it one of the most tax-friendly provinces in Canada for consumers and businesses. Edmonton is ranked 5th largest in Canada and 5th largest economy in Canada. And the government is spending billions of dollars into infrastructure, such as the expansion of the transit network. There's mixed-use developments and a lot of money that's being allocated to healthcare facilities as well. And in terms of real estate, Edmonton is recognized as the most affordable city in Canada, and it ranks 5th globally in terms of affordability. And as a city, the city is experiencing rising home prices, strong rental rate growth, and low vacancy, which we will touch on later. So without question, Edmonton's economic stability is driven by the energy sector. And Alberta has the world's third largest oil reserves, with Edmonton serving as a very critical logistics and service center for oil and gas. And the oil and gas, the energy sector, continues to drive employment and infrastructure development, ensuring economic resilience. But beyond energy, Edmonton has transitioned from an energy-dependent economy to a more diversified hub across multiple industries, ensuring that there is long-term stability and growth. And this includes innovation and technology, logistics and manufacturing, and then also healthcare, with an expansion and relocation of major corporations and institutions. And the reason why this matters for investors is because diversification beyond oil and gas makes Edmonton much more resilient to economic fluctuations. And growing industries just means more jobs, and that translates into higher rental demand. And with its fast-growing tech, healthcare, and logistics sector, we truly feel that Edmonton is proving to be a very well-rounded, future-ready investment destination that's just beyond energy. And I actually wanted to spend some time talking about Edmonton's booming tech sector because the city saw an impressive 53% increase in tech employment over the last 5 years, making it the largest growth rate among 50 cities. And this was conducted by a study conducted by CBRE. And the rapid expansion is driven by several key advantages, including affordable talent. So you can get high quality tech professionals at competitive rates. There is institutional support, so it's backed by the University of Alberta and the Alberta Medicine Intelligence Institute. You get lower operating costs. In fact, you can save up to $10 million USD in savings annually for a 5-person tech company. So huge savings there. And you have access to affordable office space. So lower real estate and operational costs, which is attracting new and growing tech firms. So overall, Edmonton offers a very cost-effective, innovative environment for tech companies to truly thrive. So not sure if anyone has heard of this particular project. It's called Wonder Valley. And it's Alberta is set to host the largest AI data center in the world. And this has an estimated price tag of $70 billion. This landmark project will drive massive growth in AI innovation and data storage, presenting huge opportunities for investors. And this project will deliver thousands of jobs. We're talking business growth and potential investments estimated at over $100 billion. Global attention, skills development, and all of this will in turn mean that there's going to be a housing demand surge with an influx of tech professionals, property value appreciation, stable rental growth, and long-term growth potential. So definitely something to keep an eye out for. And then in terms of real estate, here we're seeing rising home prices, almost close to double-digit year-over-year appreciation for all property types. We're seeing very strong rental rate growth for 1 bedrooms and 2 bedrooms, and then also very low vacancies at 2.1%. And this is for condominium apartments in the fall of 2024. So it's a very affordable market with high return on your investment with cash flow potential. So we just wanted to highlight again that in Edmonton, you can acquire a property with an average price of mid 400s. And that's with almost 11% year over year in comparison to other markets like Toronto, where it's closer to 1.1 and Vancouver. Okay, so in Alberta, you can actually get massive real estate savings because there are no land transfer taxes, no development levies, lower property taxes, meaning lower upfront capital, resulting in lower operational expenses and costs. And this all just means better profitability and overall returns. And then finally, Edmonton has fewer barriers to entry for development. So the city has fewer bureaucratic hurdles compared to other major cities, meaning that developers can navigate through the approval process and complete projects quickly and on schedule. And this also allows the purchase price to stay low while minimizing costs. So huge, massive savings in Alberta relative to other markets. And Alberta is also very landlord friendly. There's no rent control, allowing investors to set competitive rental rates based on market conditions. We're seeing a much faster eviction process. You can evict a tenant for non-rent payment in 14 days. Quite unheard of in Ontario. Particularly in let's say Toronto, which is a much longer process, taking as much as 12 months, if not more. You can ask for a damage deposit, and this covers damages or unpaid rent, which is refundable if the property is returned in good condition. Number 4, greater lease flexibility. You have the ability as a landlord to end the tenancy without cause for fixed-term leases. So for example, landlords can choose not to renew a fixed term lease at the end of its term without requiring a specific reason. Number 5, no rent freezes during emergencies. So during COVID-19, Alberta actually did not impose a rent freeze, which really maintained financial flexibility for landlords. Landlords also have simpler maintenance obligations, so still required to maintain the property. The rules are less on the landlord and specific. And in terms of the fair utilities rule, utilities are almost always the responsibility of the tenant. So even if there is, let's say, a slight discrepancy that's stipulated in the lease agreement, there is more flexibility around enforcing that the tenants will pay for the utilities. So here we are summarizing the key takeaways and why investors should act now and invest in Edmonton, because you have such affordable, you have like an affordable entry point. So Edmonton's real estate is quite undervalued compared to other major cities. You get strong rental growth, you get a diverse economy with tech, logistics, and healthcare, reducing the reliance on oil and gas. There's also landlord-friendly laws, and you get high cash flow potential because the prices are lower, you have strong rents, which means better returns. And here we're showcasing the median renter income by city again to really emphasize that Edmonton's renter income is high. And this means that the affordable rent is also high and on par with market rents depending on the bed type. So overall, Edmonton is a very high growth market with strong cash flow, rising rental demand, and unbeatable affordability. So we really want to make sure that you don't miss out on this opportunity to invest in one of the best performing markets in Canada. All right, so if you have tuned in this far, amazing, and thank you so much for listening. We still hope that you're locked in because we have some amazing incentives to share. Connect.ca is a Baker Realty partner. Brian has been working with Baker for the past 20 years, and we'll have access to the incentives that we're showing on the screen. So our team has spent a lot of time with developers to ensure that we package it in such a way that will offer you the utmost low risk but high reward investment. And these incentives are meant to save you hundreds of thousands of dollars, if not more. And it would be very difficult to find other developers who are willing to offer the same level of incentives. So we're offering free appliances for every unit. We're doing complimentary appraisal reports, environmental reports if required. You will have access to our in-house property management services at CMHC recommended rates. And if there is construction financing, the interest is entirely covered by the builder. So huge savings there, because for everyone who builds custom homes, we know that this loan is interest only and it's on the borrower to cover. The mortgage broker fees are waived if you use our in-house mortgage broker. And because this is because we are coming out with brand new developments and multifamily properties, there is coverage under the Alberta New Home Warranty, which is up to 10 years, which is amazing, actually beyond what Tarion is offering in Ontario. And we're also price matching. So let's just say once the project is complete and prior to closing, we do another appraisal on the property. If for whatever reason the value of the property is less than the purchase price, the developer will do a price match guarantee. As for price escalations, this is also fixed for any fluctuations to construction costs, for example. So those costs are fixed. Our agreements also have a conditional period. So if the application is not approved due to project or builder viability, the purchaser can actually terminate the agreement without any penalties. And then lastly, and this last incentive is actually quite gold. And the reason why we have this in place is to really ensure that as an investor, you start generating income from day one, because the builder will cover all operating costs, expenses until the property is 97% stabilized and tenanted. And on top of that, you don't close until you receive the full financing loan that's approved by the lender and CMHC. So those are our incredible incentives that we've bundled together. So again, a very low risk, high reward type of development where it gives you complete peace of mind. Okay, so to give you additional comfort, we also have 4 comprehensive checkpoints to ensure the legitimacy of the MLI Select product that we're offering. So appraisal reports and performer reports are done by reputable and professional companies. So they're not generated by Baker, they're not generated by Ryan. And we, for an additional added confidence, we also have a third-party underwriter to review all the numbers before the CPA signs off on it. And then lastly, CMHC does the final review prior to issuing the certificate of insurance, which is essentially your stamp of approval. With the certificate of insurance, you can then go to the lender, any lender, and be able to get your financing. Okay, so in terms of inventory, we have been very, very successful. In fact, we've sold over $90 million worth of MLI product to date. So inventory is moving very, very quickly. So it's in your best interest to actually contact Ryan, Connect.ca, in order to have access to the inventory that we have on hand. And the big news that we want to actually highlight here is that not only do we have inventory that's in Edmonton, but we also have inventory in Ontario. And the 2 that we have highlighted there are 2 that are in prime locations in the Toronto region, one at Yonge and Steeles and the other one at Eglinton and Midland. So an opportunity for you to be able to acquire multifamily housing right at home in Toronto. And we have many more units and many more properties coming, over 150 units that will be coming soon, comprising of 6 plexes, 8 plexes. We have 12 plexes, 48 units, small apartments, and then also mid to large scale mixed use properties as well. So we have a huge range of inventory, different property types, and the price point range from 2.3 all the way to 70 million.
That's awesome. Are we gonna, we're gonna look at some financials, right? I think we're going into that.
Yeah,
now.
of course. Yeah, so I'm sure you're all wondering, okay, so how profitable are these projects? And it's very profitable. And I'm going to let Linda take the stage and be able to walk you through an example of one of our investment packages. And this is the way that we've structured all of them so that you can get the full scope on how this works and what the financials look like. So Linda, whenever you're ready.
Great, thank you. So now you know about the program, how you can really leverage it to take advantage. You know about the local market. We have a lot of inventory that's in the Alberta market and the greater Edmonton area, and the numbers really make sense. The cash flows are very strong on them, so we'll go over that. Every package that we have is very thorough. So you see here we have the renderings. It's a breakdown. This is specifically for one project that we're selling, 68 units. Broken into, as you see, there's 2 buildings there. So there's a 51 unit 4-story building with apartment units, and then there's 17 stacked towns on the building just to the right. Within that, we actually have, sorry, how do I skip to the next? There we go. We do very thorough analysis as well about the region. So Beaumont specifically, extremely desirable area. I have gone personally out to Edmonton, done a tour of all these sites, met with the developers. This is a fantastic opportunity that we have, but the areas make sense. So as Carol mentioned, developers are very knowledgeable in the space. They've done a lot of this product. They know which areas to focus on to get you maximum rents, areas that are high growth, that have a lot of opportunity. And we do a full analysis and breakdown. So for example, Beaumont, you have very low vacancies, almost less than 1% vacancies. The rent rates are high. It's a growing area just south of main Edmonton. And these areas are actually seeing lower vacancy rates as well as higher rent rates than a lot of the core downtown areas, right? So we're choosing the right areas, great schools, for example, and this is going to give you opportunity and promise for your investment. Asking price for this product, you're at 20 million. We have the full details of the address, how the units are broken down, who the builder is, what the unit mix is looking like. So you see the breakdown of the 51 units as well as the 17. We have the site plan, and out of that gives you a good idea of what it is that you're buying. We also have all the architectural drawings for the project. So if you go to the, so you'll see the, You'll see the architectural drawings of a full breakdown of each level, what the units look like, sizable, very livable units, full breakdown as well on the whole area in terms of what's nearby, what the schools are like, all the perks and benefits. So it's a very thorough package, again, to give you all the information that you need to assess the project, including the pro formas. So pro formas are the numbers. We're going to go here just to zoom in a bit and see. So for every project, we have the project price, which for this one is at 20 mil. Down payment requirement is only 5% down. So to be able to purchase $20 million worth of property, you only need to put down 5%. So 1 million. The CMHC premium is at 2.8%, which is a lot lower than the standard CMHC premium. That 560 is also built into your mortgage cost. So it's amortized over the 50-year period. So that's another beautiful aspect. So you see there, your mortgage loan is about 19 mil, 560. Net worth requirement is 25%. So you only need to have a net worth of about $5 million in order to purchase a $20 million property. We go through each year all the way up to year 5 to give you an estimated idea on appreciation, the building value, what that would look like, year-over-year cash flow increases, how much equity you're accumulating over that time period. And you see that with the cap rate continues to go and grow over time as well. The key metrics is really what is very exciting, what you want to focus on. Your annualized 5-year equity gained ROI, is at 34.5%. So really strong ROI based on your investment. The debt service cash ratio is huge at 1.31. Pretty much means that for every dollar that you're generating, you have about an extra 30-something% of what your gains are. So for CMHC, their minimum requirement as a DSCR for a viable project is 1.1. So you can understand and see that these returns are very, very strong. And there's a lot of buffer in that gap and a lot of potential for income. Even if you want to inflate the costs a little bit more, although we are quite conservative, and these numbers, again, have been vetted by the lenders, you're going to get a very healthy return. Your payback period off your investment is about 3.6 years. At the average cash on cash return, you're looking around at 27.8% off this property. Very low expenses, good high net operating incomes, and it's all for the reasons that Carol mentioned. The prices for the properties are low as compared to the income that you can generate off of it, as well as all the costs, right? The costs are all low, the incomes are high, the affordable rent rates are very high, and they're pretty much market rates. So you're not having to take a discount off the rent rates in order to hit your affordability criteria. And that's kind of the golden ticket for properties in Alberta of why these properties really make sense.
I'm curious, are people buying personally or under corporations? Are people joint venturing, JV, and coming in together? Because it's interesting that to see a real estate investment that's $20 million, it just feels like a really heavy lift. And it's funny when you look at the numbers. I've been looking at real estate pro formas for over 20 years, and it's the same as a condo or a duplex. The numbers are the same; they're just bigger numbers. But you look at the same things to really assess an investment. So I'm curious how people are structuring these deals and what buyers look like. And I'm also curious about. Carol, you did an amazing job talking about the steps, and for everyone listening, this is why I like working with Baker. I wouldn't bring anyone on who doesn't have this type of relationship and experience vetting deals. So you guys have done a tremendous amount of due diligence to reduce risk. So I'd love to understand what potential risk there is as well.
Yeah, no, for sure. So I'll address the first side of your question, which is how are these deals generally structured? Who's buying this stuff, right? So it depends obviously on the size of the project. This is kind of a mid-range at a 20 million mark. We have some lower price point product, say 2 million, right? Where you might find an individual buyer. Predominantly though, still it is through a corporation. Most people are buying through a corporation for tax purposes, also for, just how the liability even, right? But there are predominantly corporations. And we're seeing more partnerships, right? So like you said, it is a larger price tag. Some people get a little bit, taken aback with the price, but the obligations from a down payment perspective and the net worth requirements really aren't that scary, right? So we might have two partners that go in on something like this. So they might form a corporation, purchase it together. For the large projects, so perhaps we've seen over $50 million, they set up like a GPLP structure. So it really just depends on the price tag, who the buyer is. For one of our larger projects, which is around a 50 million mark, it is just a single corporation that's buying it. They have bought multi-res property in the past, predominantly in Ontario, but they really are excited about the opportunities that Alberta brings when they see these numbers and the flexibility from a landlord's perspective. They're very excited. So that's kind of the buyer profile and how these deals can be structured.
And they'll look at the net worth. They won't look at the net worth of the corporation. It'll look like the directors or the shareholders. So there's three.
Yeah. So if there's a corporation that's purchasing and the corporation itself has enough net worth, then that's all that would be required from the lender's perspective. They wouldn't have to have any personal guarantees or go into personal. If it's a newer
corporation or something like that, I know a client of mine is a doctor. He used funds from his medical corp, so that was probably already vetted and qualified, I imagine.
Yeah. Okay. Yeah. So that's the structure. You had question about, where are the, shortfalls, where are the risks, right? Let's go to the next slide of the presentation. I just wanted to go through some of the steps. This just gives you a further breakdown of the rent rolls, how we're coming to the revenue numbers. And then the next one, how we come to the debt service coverage ratio. And then just a little bit of sensitivity around different rates. Yep. So you can go back to that one. Yeah. The pretty much the rates, what we use as a base case is at about 3.6. The bond yield rates have actually been dropping. So our bull case at 3.35, we actually have heard of some people in this market today getting closer to that number. So the numbers could be even sweeter than what we're using as a base case at a 3.6 is quite reasonable.
Yeah.
So those are the projections, just to give you a breakdown of the numbers. And then we can go to the package where we go down the breakdown of the steps. So here.
Can you go back to the cash flow? Because I just want everyone to understand the one metric and the amount of time it takes to pay it off. I think you had cash flow conservatively of around 250,000. So it's $1 million investment. I think it was maybe 275,000. I think it was on the next slide. Oh yeah, cash flow right here. Sorry. So that's like based on those cash flow numbers in that column. With $1 million investment, you're looking at roughly a 3.6 year payback period.
Yeah. So the cash flow is fantastic off these.
Yeah.
Yeah. And if we go to the brochure, here we go. Yeah. So the next steps. So just to give you foresight of kind of how the deal is structured, what is the next step, right? So we already went through the net worth requirements. Say everything is good, you qualify, we would have the worksheet submitted, obviously, to Ryan. We'd have the deposits which are required. So it's broken down into the initial deposit. You'd have a due diligence period where you're introduced to our lender immediately. So what they would do is financially vet the buyer. So you as a buyer, they're going to go through all the financial statements to make sure that you are good to go to make this purchase so you can comfortably firm on your contract. At firming, the remaining deposit is in, so that's the extra 500,000, and then the COI goes in immediately. So certificate of insurance application goes to the lender, and that pretty much is your golden ticket. For any reason, if you were to not get your COI, you would get all your money back. And this is huge. This is part of our incentive. And why it's so important is because you are indeed buying a CMHC MLI product. We're ensuring as a builder that you will get the certificate of insurance, because that's what your whole purchase is based on. All your revenue numbers are based on getting your certificate of insurance for this program. right?
It's huge. So you've just eliminated the risk. So this is why I didn't get involved with this program sooner, because I was always worried about not actually getting that certificate. So if that worst case scenario happens, the way this deal is structured is you get all your money back.
Yep. And most builders will not do this for you because it takes 3 to 6 months to get your certificate of insurance. So you're pretty much asking the builder to hold on to their product, or just wait. And if something goes wrong in 6 months, most builders will not just let you out of the deal, right? A lot of the deals that you might see on the market are remaining inventory. Builder doesn't care about CMHC MLI. They just want to sell their product. So you're firm, you're going to be firm, and they're calling it a day. That's pretty much all you're getting, right? Here, we're making sure that you're going to get vetted, you're going to get your COI approved, and then we can go ahead with your purchase. So that's a step. You get your COI, you get your lending in place, construction draws can then commence. And we'll go through it with the incentives again, just so you understand the process now. But during that time period, any of the construction draws, if there is interest on that, the builder also covers that. So that's also another huge incentive to make sure that the builders are building at cost, because we have fixed price. So they're going to continue to build fixed price. Doesn't matter if there's escalations on cost, labor, materials, they will deliver it fixed. Also, they want to deliver on time because they're covering the interest off the construction draw loan. So we have these measures in place to kind of make sure that everyone wins, everyone's on the same page, and we're working as like partners towards getting this completed, right? Yeah. For this project, you're pretty much finishing end of 2026, mid to end of 2026, and they would deliver it to you. You don't pay for any of your principal, mortgage, operating costs until we've stabilized and tenanted out for you. So that's another huge, huge benefit, because that's one of the largest costs. Filling up your property, making sure it's tenanted out, making sure you're getting the cash flow. No one ever knows how long that could take. Builder, it's their responsibility to make sure that they're doing that for you, and to kind of make it, again, that partnership. There could be a holdback. So CMHC potentially does a holdback on the loan, which is they might hold 10 to 15% until you hit stabilization. If you're a regular purchaser going through CMHC MLI, you would be responsible for paying that holdback back out to your builder, right? Paying out the rest of the loan, and then you would then stabilize the property in order to get that money back. For our case, you don't even have to worry about the holdback. So builder is on your side to get this property tenanted it out, because they want to get that holdback remaining from the lender, right? So you're not on the hook for that. And they're going to make sure that they're going to stabilize and rent it out for you. So those are the steps. We'll go to the next. Going back.
That is a really well-structured deal. For anyone who has put together a deal like that, that checks off all of the boxes to make this a very strong deal. That's great.
Yeah. So the incentives, Carol already went over most of them, but they are very, very sweet. Okay. So just letting you know, whether it is an Alberta property, and this is the beauty of why it's taking longer in Toronto. It's very hard to find properties that pencil out in Toronto, but we've also been able to manage getting the same incentives in Toronto. So the levies are all included. The broker fees are going to be included. They're guaranteeing on COI. This full package is also transferable to the Toronto, which is insane in terms of.
Will Toronto get all of the points to meet the 95.5, the 95% mortgages, or is it going to require more money down?
It's going to require more. So we're looking at 10% for those ones.
Right.
Yeah. But the returns are fantastic in the fact that we have so many extra costs in Toronto, and the developer is willing to absorb them, such as those levies.
It's a great deal. If anyone on this is interested in a potential JV with me in Toronto, I'd be interested in looking at that deal further.
Yeah. So again, just going over, these are kind of the risks in our incentives. We've addressed pretty much any risk that we could see along the way. So risk, like you said, in terms of the, getting your COI, that's the huge risk. A massive risk when you're buying any CMHC MLI product, because rules could change. They often do. I think they've had 4 changes over the last year. What happens in that case, right? You don't get your COI. you're not obligated to stick with the deal. So we're
And
making
is that
sure.
money held in, is it in trust?
So that money, no, so it's actually with the builder.
Okay.
It is held with the builder, but it is immediately returned if it were not to go through. The builder is interesting in Alberta, especially. In Toronto, how typically every project is a separate corporation, whatnot. The builder in Alberta is the builder and owns all of the projects, all the properties under their name. So for the builder, they are 100% confident in their projects, and they have to be. And they also are pretty much blacklisted in that case if they do not go ahead with any of the projects. So that's a big risk for them. They would not be able to sell any more of the CMHC MLI products. They'd be blacklisted as a builder. And even as the developers selling off land, it's a very small community. So people would not actually continue to sell them lots if they were to back out any of their deals or have any defaults. So it's a very strongly backed builder who can actually build and is building according to their construction timelines as well, regardless in some cases of whether there's a COI in place or not. And it takes a certain builder to be able to do that, right? So all those things are very important, going back to the builders.
Great. Are we, we've got a lot of questions piling up here in the chat. Are we ready to take some questions?
Yeah.
Awesome. Okay. Yeah, and we'll go back to the screen here. So there's a QR code. If you guys want to take out your phones, if you're interested in learning about these deals, we could send you individual packages, go over the details with you, kind of explain, answer any questions, more detailed questions that we may not get to today. So Adam's asking us, what about construction cost overruns?
So like I mentioned, there's actually the fixed price for all the products. So whatever price you're purchasing it for, it's a builder's responsibility to make sure that they fall within that price to make it make sense for them, right? But you're not paying anything extra.
Can you rent some of the 5 units to family members? I guess 5 plus. I think he's referring to, it has to be 5 plus units to qualify. That's accurate, right? In order for it to qualify for MLI Select, it's 5 plus units.
Yeah. So you, as long as you hit the affordability criteria, if that's how your deal is structured. So say it's affordable, you have to hit, let's say 2 units have to be affordable. You need to make sure that those are below the affordable rental rate that you need to apply. The other properties that are part of your building, you can just rent them out. They're standard rents. You can rent them for whatever you'd want, but it just has to be rented out.
Okay, and what if the units are not all rented? Did I already read that one? What if all the units are not all rented and the rental income didn't cover the monthly mortgage payments?
Carol, do you want to, sorry, I just keep talking. Do you want to answer some of the questions?
No worries, of course. So the question was, if the units are not all rented and the rental income didn't cover the monthly mortgage payments. Okay. Yeah. So the way that all of our deals are structured, all of the units, so the affordable units would be rented at the affordable rent threshold. And then all of the other units would be rented at market rents. And so all of our performas indicate that these are all cash flowing properties. So we're not really encountering a situation where that would happen. And we also had bad vacancies as part of our performance as well to cover any shortfall.
And also we have that requirement of the stabilization, right? So you pretty much are getting your property when it's stabilized. So it will be tenanted.
So you won't close on the property if it's not meeting those requerequirements, if it's not cash flow. Right.
Yeah. Well, you close, you're not covering any of the costs.
So let's just say it takes the building maybe like 3 to 4 months to be 97% stabilized and tenanted. So those 4 months, and this is after you've closed on the property, the builder is going to be the one covering all of the operating costs. So all of your mortgage payments, all the management fees that's involved, property taxes. So that's where like these huge savings and these huge incentives really come into play, because as an investor, you don't have to worry about any of those operating expenses until it's stabilized. And we want to essentially ensure that you make money from day one once the building is stabilized and 97% tenanted.
Yeah, that's great. And my good friend Prem, are there any restrictions when these properties can be sold? I believe there are. So how does that work?
Yeah, so the commitment term under affordability, for example, is a 10-year term, depending on how the deal is structured. So if it could be a 10-year commitment. It could also be like a 20+ year commitment as well, based on how you accumulate your points under the 3 components. Majority of our projects, we satisfy or we accumulate 100 points in order to get the most enhanced financing terms, because we want what's best for our investor clients as well, to be able to get like up to 95% loan to value and up to 50 years amortization with the lowest insurance premiums and lowest interest rates that closely follow the bond yields.
Now, what if a company is the purchaser? Can you sell the company at any point in time to someone else? Because the mortgage still stays in place. Nothing really changes. Can you sell the company sooner?
Yeah. So you can sell it. So even with in your term, so say you have a 10-year term, you want to sell the property, you would still have to keep it as a CMHC MLI because you need to fulfill your term requirement. The new buyer could apply. As long as they apply, they could take over your mortgage, the CMHC loan that you have. Otherwise, they could also go get their own COI, a new one, right? But there are options in order to get out if you needed to.
Can we be emailed the listings? Yeah, Temi, just take out your phone, contact us. The QR code's there, or email me. We'll send you the listings. You guys are lending the mortgage. No, they're connecting you with the lender. When we calculate DCR, can the payments be interest only, or should it include principal and interest both? Please clarify. Thank you.
Yeah, so to calculate the DSCR, it considers like both the principal and the interest payments. So we want to understand like the full debt service that comes with the property.
Yeah, and what is the credit score you are looking for? So this is the beauty of this product, is if you're maxed out, which I know many of us are getting mortgages, this kind of opens up the door to more commercial opportunities, which, you know, there's a lot more options for financing, and it gets interesting. So maybe if you guys can just talk about the qualification process a little bit, or touch on that a little bit, that'd be great.
Yeah, so this MLI Select is considered construction financing. So anything beyond 5 units would be considered construction financing as opposed to residential financing. And in the commercial space, the lenders will look at your net worth as opposed to your personal income and your credit. So those are quite important as well. Overall, the lender wants to see your financial strength and financial capability, but they're primarily looking at your net worth. And they're looking at how well the building is overall performing, which is why the DSCR is so critical at a minimum of 1.1. So the example that Linda was sharing, the one in Edmonton, that one had a very strong DSCR of 1.31. So that one will generate enough income in order to cover its debt obligations.
So technically, any income would qualify because they're going to look at your net worth. So they're looking at the property, and then they're looking at your net worth. And if you don't qualify, you're essentially in a conditional period where you then get out of the deal if you don't qualify.
Yeah. Yes. So during the conditional period, we'll introduce you to a CMHC preferred lender. So unfortunately, you wouldn't be able to just go to any of the top 5 banks in order to qualify for this program. We're working with specific lenders that have experience working with CMHC MLI Select, and we know how to qualify you as a borrower.
Awesome. How does the property management component work? Is the builder offering the property management? Can you hire your own management company? How does that get put in place?
Yeah, so the experience is one of the criteria that CMHC will look at. And the good news is that for ease of qualifying, our developers either one have their own in-house property management team that can oversee these properties, or they have a third-party property management company that you could use. But if you have at least 5 years of experience managing similar properties, then you can 100% be able to manage them yourself. But of course, you need to be able to show CMHC that you do have the experience, and they may ask certain information to qualify you to make sure that you meet this criteria.
Awesome. Temi, yes, you can come in with other partners to qualify. You could set up a corporation, or you could go on individually as a joint venture or limited partnership. There's options. I think most purchasers are probably doing it with groups. Okay. What else do I have? What additional expenses could purchasers potentially expect? So we know how much money they need to put into the deal. I guess Edmonton's going to be a lot different than Toronto, but the developer is covering a lot of those. So maybe walk us through what else to expect. And is there any unexpected expenses or surprise things to be aware of?
So similar to closing on any property, there will be closing costs, right? So that's something that you would want to prepare for financially. But a lot of our expenses, or a lot of the incentives that we are offering, will cover some of the what would typically be seen as like unforeseen costs that would come up, but that's all been covered as part of our bundled incentive package. So aside from that, it would be your typical closing costs that you would have with respect to legals, land transfer taxes, and whatnot.
Yeah. There's on closing CMHC fee, which is that 2.8% that we show, but that's also rolled into the mortgage and amortized over 50 years. So that's the other beauty of this. Even in terms of the CMHC application fee, which you would have to pay, usually it's around $150 a unit. Nothing crazy or substantial, but still an added cost. And a lot of times those can all be wrapped in, even in terms of the lender fees. So broker fees are covered. Lender fees are always typical for any of the commercial loans, but that is also something that could be rolled into your mortgage as well.
Okay, I'm going to take one last question. I know Bobby asked something, and I don't want to leave you hanging, Bobby, because you asked a few things. COI is project specific, ?
Yeah, the COI is specific to that project and that borrower who's looking to qualify under the MLI Select program.
Awesome. Well, let's wrap it up. I thank you so much. It went a little longer than we expected. We're going to send out a recording to everyone. I found that very informative. I've been waiting for Baker or someone like Baker to put this program together, because you guys have done a really good job at vetting the process, doing the due diligence, and putting this together in a package that is easier to understand and just kind of delivered on a silver platter. So I appreciate your time. Thank you for educating us. Everyone who tuned in, we're going to send out an email with the recording and some further details. And anyone interested, please reach out to me or someone on my team. Linda, Carol, thank you so much. We'll see you soon.
Great.
Thank you.
Thanks, Ryan. Thanks, everyone.
Have a great night. Thank you.
Take
care.